Thanks, Jeremy, and good morning, everyone. My name is Nicole Johnson-Barnes, and I cover international and global equities. Today, I will detail several of the major global risks impacting global markets as we head into 2020. And as you can tell from my session title, so many risks, so little time, there's a lot to cover in the 15 minutes that I have with you. So let's get started. In terms of the agenda, I'll begin with an overview of the current outlook, and then drill into the main areas of geopolitical and economic uncertainty with our allies in the developed East, our neighbors to the far West, and within our borders. I'll conclude by sharing my thoughts on how the market might respond to these unresolved issues, and then with a subtle reminder of the golden portfolio management rule. Before diving into the current state of the economy, let's take a quick trip down memory lane to the end of 2018. If you can remember, the S&P 500 was down about 13% for the quarter. Contentious trade negotiations between China and the U.S. were really getting larger and more prickly. Brexit negotiations were far from being settled with the looming March 29th deadline. And globally, there was a marked slowdown in economic activity. While equity markets have broadly rallied back from last year's meltdown, underlying financial signals continue to point to an economic lull. As shown, the OECD's 2019 GDP growth estimates have become increasingly pessimistic. In May 2018, their outlook for the 44 countries studied was fairly positive, with roughly 80% of those economies expected to see expanding GDP growth. A year later, their forecasts were broadly pessimistic, with only 5 countries anticipated to end 2019 with accretive GDP growth. These weakened estimates can be attributed to the sustained high level of economic uncertainty, political uncertainty, which has caused major components of GDP, net exports, and business investments to tread lower. One of the more telltale signs of a slowing economy is a decline in manufacturing. Since mid-2018, the narrative from producers around the world has been slowing demand, delaying of capital investment, and trepidation about passing higher costs of tariffs onto their consumers. And as you can see in the chart, which shows historical manufacturing PMIs for developed markets, emerging markets, and the global aggregate, up until about 2018, manufacturing was expanding, led by month-over-month increases in net exports and new orders. However, since then, that overall trend has been downward and weakening. The global composite now sits at the contraction threshold. As indications of a decelerating business cycle, slackened manufacturing, and intensifying trade war carry forward, we all eventually turn to the rising beacon of insight, wisdom, and non-fake news. Twitter, yep, I'm talking about Twitter. With growing pockets of financial and civil anxiety throughout the world, Twitter became a barometer for market volatility. There were more tweets on monetary policy, political posturing, protests than any of the celebrity rants that we're used to. And what's behind those chirps are several of the global risks that I'll touch on today. Starting with difficulties in Europe, I'll focus my comments here on the 2 Eurozone elephants in the room, Brexit and the sputtering German economy. And in preparation for today's talks, and more aptly as required to continue to earn my paycheck, I took a 10-day business trip to Edinburgh and London to complete on-site meetings with 7 of our UK-based asset managers. While bouncing from meeting to meeting, knocking back cup after cup of English breakfast tea, I was able to engage in several conversations with locals on the topic of Brexit. A common theme emerged that English and Scottish folks alike were generally tired of hearing the never-ending story of Brexit. On the slide above, you'll see a few of the safe-for-work comments that I gathered from Londoners, a Scotsman, and a rather frank cabbie, which I'm pretty sure that I annoyed by my repeated ask for him to repeat himself. Their general disdain is best summed up by the top quote from Baroness Lucy Neville-Roth, who I met while touring the House of Commons. Delay and indecision is both costly and corrosive. Confirming those observations, UK business and consumer confidence indicators are showing signs of apprehension amongst the Brits. I'm sure you've all heard of the English expression, keep calm and carry on. Well, the data suggests that they've been keeping more fidgety than calm this year. UK business sentiment has plummeted as companies brace for the worst-case no-deal scenario. In their attempts to carry on, UK consumers appear to be wavering around the neutral mark, showing declining confidence as the first Brexit deadline approached, and then regaining strength with the announcement of the October 31st extension. What's causing businesses to pull back and making consumers nervous Nellies has been both the increasing likelihood of a no-deal Brexit and the realization of the potential short and long-term consequences of losing their single market access with the European Union. While chances of a no-deal conclusion have decreased with Parliament's recent bill, the published Yellowhammer report details a laundry list of negative economic and social costs that will be triggered by a hard exit. The map above provides context on the UK's interdependence on the rest of the EU, and as you probably can guess, Britain's major trading partner, constituting more than half of its imports, is the EU, with Germany, that orange circle in the center, being its top supplier of goods. Switching gears to Germany, in August we learned that quarterly GDP for Europe's largest economy registered a negative 0.1% growth rate in the second quarter. Business climate within Germany has declined to levels not seen since 2012. There's been monthly declines in German manufacturing PMI since the start of 2019, with the August reading dangerously close to a 7-year low. These factors, amongst others, further strengthens the widespread expectation that third quarter GDP will be negative. And if so, it would mark the second consecutive quarterly contraction, meaning the German economy could potentially be in a technical recession this year. And similar to the Dunkin' Donuts slogan, the German economy runs on exports. Particular production and delivery of automobiles, automotive parts, heavy machinery, and chemicals. And according to the World Bank, net exports made up 47% of German GDP in 2018. When global tensions are high, as they are today, the resulting slowdown in demand has material repercussions on export-driven economies like Germany. In particular, we've seen the German auto industry slump, with BMW stocks moving to double-digit lows. The automotive industry is Germany's largest industrial sector, with roughly 78% of the cars produced in Germany last year destined for international markets. All right, let's turn our attention to Asia. In lightning round fashion, I'll hit on the key quandaries within China, specifically the trade dispute and the protests within their borders. And I'll touch on the brewing middleweight fight between Japan and South Korea. U.S.-China trade negotiations show no current signs of subsiding. And I think we are all mentally worn out by the repeated tit-for-tat trade rhetoric, which is often followed by an exaggerated shift in the market. And as you can see, the latest round brings total tariffs on China to a whopping $600 billion. And as more tariffs are threatened, U.S. consumers will ultimately feel the pinch. With each list and each iteration, more products are being included that affect our daily lives. And while I vaguely know that a catalytic converter is an essential part of our 2003 Jetta's exhaust system, that's right, we're driving an antique. A 25% price increase wouldn't really play into our monthly budget, so long as the car is still running, knock on wood. However, I love seafood, cooking with garlic, and generally wear clothing made from woven fabrics. And given the rate at which my dog Henry dismantles those stuffed squeaky toys, that 25% increase will likely sting if imposed during the holidays. Looking beyond soybeans and the pending tariffs, one of the major sticking points in these trade negotiations has been China's habitual disregard for intellectual property protection. For instance, in January we learned of a US government indictment against Huawei, a Chinese telecom company. Huawei was accused of stealing trade secrets from T-Mobile, in particular, their Tappy technology. This isn't the first time a US firm has accused a Chinese firm of IP theft. Multinational firms like IBM, GE, and Apple have also reported and pursued cases, and it is estimated that China's IP shoplifting cost American companies $600 billion annually. Meanwhile, China has mounting issues within its borders when it comes to civil unrest in its crown jewel, Hong Kong. The anti-extradition bill movement was formed in response to a new amendment that would allow for the extradition of criminals to mainland China. And who wants to go to jail in China? Undermining the autonomy of the region, of course, and those Hong Kongese civil liberties. On the side above, you can see a couple of the photos of these massive protests. And this past Sunday, September 29th, marked the 17th consecutive week of demonstrations. And we are starting to see the effects of the unrest in financial markets, with Hong Kong's Hang Seng Index down nearly 15% since the start of the protest. Macau casinos and luxury brands are also feeling a pain, as it's hard for their key customers, Chinese customers, to get to the slot machines or buy a new Gucci bag when there are tens and thousands of protesters standing in their way. Another growing concern is the deteriorating trade relationship between Japan and South Korea. The standoff between the two nations started in July, when Tokyo placed tighter controls on exports of 3 chemicals to South Korea. Those chemicals, which are used to make computer chips, are vital to Samsung and other South Korean companies that make semiconductors. Given that South Korea is Japan's third largest trading partner, buying $54 billion worth of Japanese goods, this escalating feud adds to the elevated levels of trade dysfunction in the region and expands the wave of protectionist tactics. And you can see initial reverberations in both local index performance. What's shown above is the price return for the Nikkei index, Japan's index, Korea's composite stock price index, and 2 of Korea's largest semiconductor companies, LG and Samsung. And there has been a negative trend in performance since mid-July for all 4, with LG and Samsung largely feeling the brunt of supply chain delays. Let's move on to potentially the largest stronghold of market uneasiness, the United States. While I've spent most of this talk describing areas of concern internationally, I would be remiss if I didn't chronicle the macro and political pressures weighing on our economy. And the list of uncertainties just continues to grow and grow. Manufacturing PMI fell below 50 in August, the lowest reading in the last 3 years. The yield curve inverted twice in the same month. New York Fed is calling for a recession in the next 12 months. Trade negotiations with China are far from finalized. And our commander-in-chief just simply refuses to give his Twitter fingers a rest. In closing, there are no overnight solutions to the risks outlined today, and markets will remain choppy until a resolution is put in place. If Brexit is ironed out by October 31st with an amicable trade and customs deal, I would expect the pound to stabilize as the UK charts a path forward. And partially wishful thinking, if a small slither of a tiny trade deal between the US and China is brokered by year end, I would expect the markets to respond positively. While short-term volatility caused by these events will continue to churn out headline buzz, it's important to remember that short-term market corrections have little bearing on your long-term portfolio performance. So hold tight to your strategic asset allocation, remain diversified, and ignore the tweets. Thank you.